Hello, good day. How are you? I hope you are fine. How's your study so far? What is dividend? How would share price change on ex-dividend date? This video introduces the basic concepts about dividend and the mechanics of dividend payments. Many investors buy common stock for the anticipated cash dividends. Understanding the basic concepts about dividend will help investors make better investment decisions. Dividends represent the return on the investment made by the stockholders. As such, dividends are tangible evidence of the value created by the firm for its owners. Let's learn together. Any direct payment by the corporation to shareholders may be considered part of dividend policy. Let's understand several key terms and their interrelationships. Dividend is a cash distribution of earnings. The most common type of dividend is in the form of cash. If a distribution is made from sources other than current or accumulated retained earnings, the term distribution rather than dividend is used. What is the difference between dividend and liquidating dividend? Well, dividend is a distribution of earnings, while liquidating dividend is a distribution from capital. The payment of liquidating dividend usually means that some or all of the business has been liquidated, that is, sold off. The most common type of dividend is in the form of cash. Regular cash dividends is usually paid twice a year. As the name suggests, these are cash payments made directly to shareholders, and they are made in the regular course of business. In other words, management sees nothing unusual about the dividend and no reason why it won't be continued. Sometimes firms will pay a regular cash dividend and an extra cash dividend. By calling part of the payment extra, management is indicating that the extra part may or may not be repeated in the future. A special dividend is similar, but the name usually indicates that this dividend is viewed as a truly unusual or one-time event and won't be repeated. Paying a cash dividend reduces corporate cash and retained earnings. Paying liquidating dividend reduces paid-in capital. Who make the decision on dividend payment for a corporation? Well, the decision to pay a dividend rests in the hands of the board of directors. The board of directors pass resolution to pay dividend. If the firm has already established a precedent of paying dividends, the decision facing the board is usually whether to maintain or increase the dividend, and that decision is based primarily on the firm's recent performance and its ability to generate cash flow in the future. Boards rarely cut dividends unless they believe that the firm's ability to generate cash is in serious jeopardy. When a dividend has been declared, it becomes a liability of the firm and cannot easily be rescinded by the corporation. Let's learn about some key dates. If you are an investor who wishes to buy share and receive dividend, I'm sure these dates are of interest to you. Declaration date is the date a dividend is formally declared by the board of directors. When a firm's directors declare a dividend, they issue a statement indicating the dividend amount and setting three important dates: the ex-dividend date, the date of record, and the payment date. What is ex-dividend date? Ex-dividend date is the date upon which the stock brokerage companies have uniformly decided to terminate the rights of ownership to the dividend. Due to the time needed to make a bookkeeping entries when a stock is traded, the stock begins selling ex-dividend 2 business days prior to the date of record. Purchasers of a stock on ex-dividend do not receive the current dividend. Date of record is the date at which the stock transfer books are to be closed for determining the investors to receive the next dividend payment. All persons whose names are recorded as stockholders on the date of record receive the dividend. These stockholders are often referred to as holders of records. The payment date is the actual date on which the firm mails the dividend payment to the holders of record. It is generally a few weeks after the record date. Let's have a quick quiz to test your understanding. There are 2 questions here. Let's try and answer on your own first. What is your answer? The answer for question 1 is 27 January. Tuesday is the last day to buy the stock in order to receive dividend. Ex-dividend means exclude dividend. The buyer will not receive dividend on 28 January as his name will not appear on the list of holders on time due to clearing process. For question 2, the answer is yes. The seller will receive dividend even though he sells the stock on Wednesday 28. In this slide, I have listed more explanation about ex-dividend dates. Under stock exchange rules, shares are traded ex-dividend on and after the second business day before the record date. Obviously, the ex-dividend date is important because an individual purchasing the security before the ex-dividend date will receive the current dividend. An individual purchasing the security on and after this date will not receive the dividend. A share of equity becomes ex-dividend on the date the seller is entitled to keep the dividend. How is the share price behavior on ex-dividend date? Well, the share price will fall on the ex-dividend date, assuming no other events occur. It is worthwhile to note that this drop is an indication of efficiency, not inefficiency, because the market rationally attaches value to a cash dividend. In a world with neither taxes nor transaction costs, the share price would be expected to fall by the amount of the dividend. Let's look into an example about how share price would change on the ex-dividend date. Would share price increase or decrease? What do you think? Well, the share price would fall by the value of the dividend to be paid to reflect the intrinsic change in the value of the share. Suppose, for example, that a share has a price of P plus 1 before X date. The dividend to be paid is £1 per share. When the share goes ex-dividend on X date, the share price will fall by £1 to P. Take note that the amount of the price drop may depend on tax rates. From the previous example, If all investors are in the 25% bracket and the dividend is £1, the share price should fall by 0.7 pound on the ex-dividend date. Watson and Head in 2019 present an interesting figure about the timings of dividend announcement and payment. The long-term upward trend is punctuated by falls in the share price on the company's ex-dividend dates. This slide shows a real-world example with Microsoft share. Take note of how the share price has dropped on ex-dividend dates and how the change in price also reflects the tax rate on dividends. For the same example on Microsoft share, we shall look into the share price data on the ex-dividend date. If you use Yahoo Finance as a reference for share price, you will notice there is a difference between the reported closing price and adjusted closing price. The adjusted closing prices have a smooth trend as the share price has been adjusted for dividend payment. There is no sharp decrease in the adjusted close price on ex-dividend dates as compared to the original closing price. Finally, we have come to the end of this video. I hope you have benefited from the presentation and content in this video. If you like this video, please click like, subscribe or share. Thank you, see you and goodbye.